Namaste and welcome back to Fintamin. I am your financial guide and this is course number 2, the Mutual Funds Masterclass. If course 1 was your introduction to the stock market, this course is where most Indian investors will find their biggest wins. Because the truth is, for the majority of working professionals, mutual funds are the most powerful and most practical wealth creation tool available. Over the next 10 modules, we will cover everything from what a mutual fund actually is to SIP versus lump sum to the hidden cost of regular plans to how to build a complete mutual funds portfolio for your risk profile. Here is your roadmap for this course. Module 1 explains what a mutual fund is and how it works. Module 2 covers the different types such as equity, debt, ELSS, and index funds. Module 3 teaches you to read a fund fact sheet. Module 4 is SIP versus lump sum and the magic of compounding. Module 5 is one of the most important, that is, direct versus regular plans, a difference that can be worth lakhs over time. Module 6 and 7 covers charges, risk ratings, and how to evaluate the tax module, STCG, LTCG, ELSS, and tax harvesting. Module 9 gives you a 5-step framework for choosing the right fund. And Module 10 builds your complete mutual fund portfolio. Let us begin. What is a mutual fund? The concept is simple, powerful, and completely misunderstood by most people. Let me clear that up right now. Imagine 1,000 people, each contributing 10,000 rupees. Together, they have 1 crore rupees. Now imagine a professional fund manager invest this 1 crore across 50 to 100 companies. Everyone gets returns proportional to what they contributed. That is a mutual fund or Samuhik Nidhi in Hindi. Before mutual funds, if you had 10,000 rupees to invest, you could buy shares of maybe one or two companies. With a mutual fund, your 10,000 rupees instantly buys a piece of 50 to 100 carefully selected companies. This is the power of pooling. There are four main benefits. 1. Professional management by experts. 2. Automatic diversification. 3. You can start with as little as 500 rupees per month. And fourth, everything is regulated by SEBI and completely transparent. Let me introduce you to the people behind your mutual funds. They are key participants in a mutual funds. At the top is SEBI, the Securities and Exchange Board of India. They regulate everything. No fund can operate without SEBI approval. Your money is safe because of SEBI. Next is AMC, which means Assessed Management Company. This is the fund house. HDFC AMC, SBI Mutual Funds, Axis AMC, etc. They create and manage the funds. They charge you an expense ratio for this service. Then comes the fund manager, the expert who decides which stocks and bonds to buy and sell. Their track records matters enormously. Check how long a fund manager has been running a particular fund before you invest. Send you statements. The custodian holds the actual securities. CDSL and NSDL for direct stocks, and CAMS or KFintech act as the registrar and transfer agents. They maintain your records and send you statements. Here is the most reassuring thing. Your money never sits with the AMC directly. It goes to the custodian. Even if the AMC shuts down, your money is safe. It means understanding NAV. NAV is net asset value. Is to a mutual fund what share prices is to a stock. It is the price of one unit of the fund. The formula is simple. Total assets of the fund minus total liabilities divided by total units outstanding. This is calculated and published every business day by 11 p.m. Here is the most common misconception I encounter. People think a fund with NAV of 20 rupees is cheaper than one with NAV of 500 rupees and then therefore a better deal. This is completely wrong. A fund with NAV 20 and one with NAV 500 can have identical underlying portfolios. What matters is the percentage return, not the absolute NAV number. Never choose a fund because its NAV is low. Compare returns, not NAV values. Mutual funds versus direct stocks. Should you invest in mutual funds or directly in stocks? The answer depends on your time, knowledge, and interest. Mutual funds requires minimal research, which is done by the fund manager. You can start with 500 rupees. You are automatically diversified across 50 to 100 stocks. And ELSS funds even save you tax. Direct stocks require deep research for every company. You need at least 5 lakh rupees to build a properly diversified portfolio of 15 to 20 stocks. And you need time to monitor quarterly results. My recommendations for 99% of working professionals: start with mutual funds. Add direct stocks only after 3 or more years of learning and with surplus capital beyond your mutual fund portfolio. Now that you understand what a mutual fund is, let us explore the different types available to you. Module number 2 is types of mutual funds. SEBI has classified all mutual funds into 36 categories. But for working professionals like you, 6 types covers 95% of your needs. Let me walk you through each one. The mutual fund universe. Type 1 is equity funds. These invest primarily in stocks, highest risk, highest return potential, best for goals 5 years or more away. Examples include large cap funds, mid cap funds, and ELSS. Type 2 is depth funds. These invest in bonds, government securities, and money market instruments. Lower risk, stable returns. Best for goals 1 to 3 years away. Think of them as smarter alternatives to fixed deposits. Type 3 is hybrid funds, a mix of equity and debt, balanced risk, good for medium term goals of 3 to 5 years. Type 4 is index funds. These passively track an index, Nifty 50 or Sensex, ultra low cost, no fund manager bias. the most recommended starting point for new investors. Type 5 is ELSS, Equity Linked Savings Scheme. This is only mutual fund that gives you a tax deduction under Section 80C of the Income Tax Act. 3 years lock-in. Equity returns plus tax benefit. Each salaried professional should have this. Type 6 is ETF or Exchange Traded Fund. Like an index fund but traded on stock exchange like a share. You need a demat account to buy it. My recommended starting portfolio: index fund for core holding, ELSS for tax saving, liquid fund for emergency money. These three alone serve 80% of working professionals' financial needs. Equity funds. Within equity funds, SEBI has defined specific categories based on market capitalization. Large cap funds must hold at least 80% in the top 100 companies by market cap. These are the safest equity funds, lower volatility, steady returns, best mid-cap funds. Mid-cap funds must hold at least 65% in companies ranked 101 to 250 by market cap. Higher growth potential but more volatile. You need a 7-year plus horizon here. Small cap funds hold companies ranked 251 and below. Highest risk, highest potential reward. Only for investor with a 10 years plus horizon and a strong stomach for volatility. Flexi cap funds can invest in any combination of large, mid, and small cap based on the fund manager's discretion. These give the manager maximum flexibility. For most beginners, start with large cap index fund. Add a flexi cap or mid cap fund after 2 years of experience. Depth fund or stability over returns. Debt funds are often ignored by retail investors in India, which is a mistake. They are not for elderly or the conservative. They serve a very specific purpose in any well constructed portfolio. Liquid funds are for money you may need within 91 days. Emergency funds, short-term parking, they give slightly better returns than a savings account with almost zero risks. Ultra short duration and short duration funds are for goals 6 months to 3 years away. Historically, they have beaten fixed deposit returns on a post-tax basis. Gilt funds invest in government securities only. They benefit with RBI cuts interest rates. When you expect a rate cut cycle, gilt funds can give equity like returns with much lower risks. One important warning: debt funds carry credit risks. Always check the credit ratings of the portfolio. Stick to AAA rated debt funds. Never chase high returns in debt funds. If a debt fund is promising 12%, something is wrong. ELSS, the tax saver equity fund. This slide could save every viewer watching this up to 46,800 rupees in tax every single year. So pay attention. ELSS, Equity Linked Savings Scheme, gives you a tax deduction of up to 1.5 lakh rupees under Section 80C. In this 30% tax bracket, that is a saving of 46,800 rupees per year. Every year for as long as you invest And here is what makes ELSS the best ATC instrument. The lock-in is only 3 years. Compare that to PPF at 15 years. Tax-saving FD at 5 years and NSE at 5 years. ELSS wins on lock-in period. The returns have historically been 12 to 15% CAGR over 7 or more years. Tax saving FD gives you 7% and that returns is fully taxable. ELSS gives better returns and saves tax. It is a double benefit. Practical advice. Start a SIP of 12,500 rupees per month in any good ELSS fund. That is 1.5 lakhs per year. The full ATC deduction. And you are done with tax planning for the year. Index funds versus active funds. This is one of the most debated topics in all of mutual funds investing. Active funds have a manager trying to beat the index. Index funds simply copy the index, which is better. Here is the data. Over a 10-year period, more than 80% of active large cap funds in India have underperformed the Nifty 50 index. That means 80 out of 100 active large cap funds managers have done worse than simply investing in the index. And they have charged you 1 to 2% expense ratio per year for the privilege of underperforming. For large cap exposure, index funds win almost every time. Ultra low cost, that is 0.1% expense ratio. No manager risk. Warren Buffett himself recommends index funds for most investors. However, and this is important, in the mid cap and small cap space, skilled active fund managers can genuinely add value. The Indian market in these segments is less efficient, giving good managers room to outperform. My recommendation: use a Nifty 50 index fund as your core holding, 50 to 60% of your equity allocation. Then selectively add active mid cap or flexi cap funds for the rest. Now let us learn how to evaluate any fund before you invest in it. Module 3: The Fund Fact Sheet. Module 3 is reading a fund fact sheet. Reading a fund fact sheet. Every AMC publishes a fact sheet every month. This is your fund's report card. Let me show you exactly what to look for. What is a fund fact sheet? A fun fact sheet is a 1 to 2 page summary that every AMC publishes monthly. It contains everything you need to evaluate a fund. And the good news, you can download any fund's fact sheet for free from AMC website. 6 key things to check. First, NAV and its movement over time. Second, AUM or assets under management. How much total money is in this fund? Larger AUM means stability. But very large AUM can hurt returns in mid and small cap funds. Third is returns. The fact sheet shows 1 year, 3 year, 5 year CAGR returns. Always compare these to the benchmark. Did the fund beat its index or by how much? Fourth is portfolio holdings. What are the top 10 stocks in this fund? Are they concentrated in one sector? Is the fund overlapping too much with the index? Fifth is expense ratio, the annual fee charged by the AMC. Lower is always better. A direct plan fund should have an expense ratio of 0.1 to 0.5%. Sixth is the benchmark. Every fund has a benchmark index it is trying to beat. If the fund consistently underperforms its benchmark over 3 and 5 years, that is a red flag. How to read fund returns. Fund fact sheets show returns in multiple ways. Most investors read the wrong number. Let me fix that. Absolute return is the total gain since you invested. 40% since you put in money 3 years ago. Sounds good? But without knowing the time period, it is meaningless. CAGR, compounded annual growth rate, is the annualized return. It tells you what percentage you earn per year on average. 40% in 3 years equals approximately 11.9% CAGR. Always use CAGR for comparison, especially for anything 3 years or longer. Rolling return is most sophisticated measure. It calculates the CAGR for every possible holding period. A fund with consistent 12% rolling returns across every 5 year period in its history is far more reliable than one that gave 20% once and 6% another time. Red flag. Any fund that only shows 1 year returns and hides its 5 years comparison is probably hiding underperformance. Green signal. A fund that consistently beats its benchmark over 3, 5, and 10 year CAGR periods. Analyzing the fund's portfolio. The portfolio section is the most important page in any fact sheet. It shows you what the fund actually owns on your behalf. If the top 10 holdings are more than 60% of the fund, it is a concentrated fund. That means higher risks and reward if the manager's bets are right, and higher loss if they are wrong. If more than 35% is in a single sector, you are effectively taking a sector bet, not a diversified equity bet. Make sure that is intentional. Check the portfolio PE ratio versus Nifty PE. If the fund's PE is much higher than the Nifty, the manager is making growth bets at premium valuations. If lower, the manager is value oriented. And importantly, check the fund manager's tenure. Has the same manager been running this fund for 3 years or more years? If the manager changed recently, the historical returns may not reflect what you will experience going forward. Fund, fund ratings from Value Research and fund ratings and what they mean. Fund ratings from Value Research and CRISIL are the two most trusted in India. A 5-star value research rating means the fund is in the top 10% of its category for risk adjusted returns over 3 years. But here is the critical warning: ratings are backward looking. A fund that was 5-star 3 years ago may be a 3-star today if the manager changed or the strategy drifted. Use ratings as a first filter, not the final decision. My approach: shortlist 5 funds with 4 or 5 stars. Then analyze each one's fact sheet manually using the checklist from the previous slide. Then choose the best one or two. Do not just buy based on a star rating. Now that you know how to evaluate a fund, let us talk about how to invest. Module number 4 is SIP versus lump sum. SIP versus lump sum, the two main ways to invest in mutual funds. Each has its place. Let me show you when to use which. What is SIP? SIP means Systematic Investment Plan. Means investing a fixed amount every month automatically. Think of it as an EMI, but instead of paying a bank, you are paying your future self. You set up a SIP of say 5,000 rupees per month. On the 5th of every month, 5,000 rupees is automatically debited from your bank account and invested in your chosen fund. You do not have to remember. You do not have to time the market. It just happens. The magic of SIP works through 3 mechanisms. First, rupee cost averaging. When markets fall, your 5,000 rupees buys more units. When market rise, it buys fewer. Over time, your average cost per unit is lower than the average NAV. You benefit from every correction automatically. Second, it removes emotion. The most dangerous question in investing is the right time to invest? SIP removes that question completely. You invest every month regardless of market conditions. Third, the compounding effect is extraordinary. A SIP of 10,000 rupees per month for 20 years at 12% CAGR grows to approximately 1.5 crore rupees. Your total contribution is only 24 lakhs. The remaining 1.26 crores is purely compounding. That is the eighth wonder of the world at work. SIP versus lump sum. When to use which? SIP is best for regular salaried income. You get your salary, a portion goes into your SIP automatically. Simple, disciplined, and effective. Lump sum is best when you receive a large amount suddenly. A bonus, inheritance, property sale proceeds, or maturity of an insurance policy. But here is the key. Invest lump sum only when the market is at reasonable valuations. If Nifty PE is above 25, consider spreading the lump sum over 6 to 12 months using systematic transfer plan from a liquid fund. The smallest strategy combines both. Maintain your monthly SIP always and deploy any windfall as a lump sum during market corrections. SWP, Systematic Withdrawal Plan, is the reverse of SIP and it is one of the most underused tools in Indian personal finance. Here is how it works. You invest a large corpus, say 50 lakh rupees, in a hybrid or balanced fund. You set up a SWP of 25,000 rupees per month. Every month, 25,000 rupees is automatically redeemed and sent to your bank account. Now, here is the beautiful part. If the fund earns 10% per year, that is 5 lakh rupees in returns, you are only withdrawing 3 lakh rupees per year. So the corpus is actually growing while you withdraw. This is how you create a monthly salary from your investments. And on the tax side, only the gain portion of each withdrawal is taxed, not the full withdrawal. Compare that to FD interest, which is 100% taxable at your slab rate. SWP is dramatically more tax efficient. For anyone approaching retirement or for anyone who has received a large inheritance or property sale proceeds, SWP from a mutual fund is the most intelligent way to generate monthly income. The power of compounding. I want to show you one comparison that will change how you think about money forever. Rahul starts a SIP of 10,000 rupees per month at age of 25. He invests only for 10 years until age 35 and then stops completely. His total investment is 12 lakh rupees. Priya starts the same SIP of 10,000 rupees at the age 35 and continues for 25 years until age 60. Her total investment is 30 lakh rupees. At age 60, assuming 12% CAGR, Rahul's corpus is approximately 1.7 crore. Priya's corpus is approximately 1.2 crores. Rahul invested less than half the money Priya did and ended up with the 50 lakh rupees more simply because he started 10 years earlier. This is the compound interest effect. This is why I say the best time you start investing was 10 years ago. The second best time is today, not tomorrow. Today. Now, let us talk about something that could be costing you lakhs without you even knowing. That is direct versus regular plans. Module 5 is direct versus regular plans. This is possibly the most impactful module in this entire course in terms of pure rupee impact on your wealth. Give me 5 minutes and I will show you why. Every single mutual fund in India has two versions, a direct plan and a regular plan. The underlying portfolio is identical. The fund manager is the same. The stock held are the same. The only difference is who you buy it from and the cost. Regular plan is bought through a distributor, your bank, your broker, or a financial advisor. The distributor earns a commission called trail commission, typically 0.5 to 1.5% per year from funds returns. This commission comes from you indirectly through a higher expense ratio. The direct plan is bought directly from the AMC or through platforms like Zerodha Coin, Grow, or MF Central. There is no distributor, no commission. The expense ratio is 0.5 to 1% lower. Your NAV grows faster because less is deducted daily. Now here is the number that will shock you. On a SIP of 10,000 rupees per month over 20 years at 12% CAGR, the regular plan grows to approximately 75.9 lakh rupees, whereas the direct plan grows to approximately 99.9 lakh rupees. The difference 24 lakh rupees. Same fund, same manager, same portfolio. Just a different plan. 24 lakh rupees is the cost of investing in a regular plan. If you are currently in a regular plan, switch to direct today. I will tell you exactly how. The real cost of regular plans. Most people in India are unknowingly invested in regular plans. When you walked into your bank and relationship manager helped you invest in a mutual fund, they put you in a regular plan. That relationship manager earns trail commission from your returns every single year you stay invested. Your bank is not giving you investment advice out of goodwill. They are selling you a product. The product they sell you may not be the best product for you. It is often the product that pays them the highest commission. The solution is simple. Switch to direct plans. Go to mfcentral.com, the official CAMS and KFintech joint platform, and switch all your existing investments from regular to direct. It takes 10 minutes and is completely free. Where to buy direct plans? 5 platforms where you can buy direct plans in India. First is the AMC's own website. Go directly to hdfcmf.com or sbimf.com and invest. Second, mfcentral.com. All AMCs in one place, completely free and SEBI approved. Third is Zerodha.coin. Excellent interface integrated with your brokerage account. Fourth is Grow or Kuvera. Free, user-friendly, goal-based investing. Fifth, CAMS or KFintech directly. One critical warning. When you use Grow, make sure you specially select the direct plan. Grow shows both regular and direct options. Always look for the word direct in the fund name before you invest. Now let us look at all the charges you pay on mutual funds. That is model number 6, expense ratio and exit load. Two charges that silently eat into your returns. Most investors have no idea how much they are paying. Let me make it crystal clear. Expense ratio, the annual fee. The expense ratio is the annual fee charged by the AMC for managing your money. It is deducted daily from the fund's NAV. So you never see it as separate deduction. It is completely invisible. For a direct index fund, the expense ratio is 0.1 to 0.2% per year. For a direct active equity fund, it is 0.5 to 1%. For a regular active fund, it is 1 to 2%. For a regular index fund, and this is where it gets absurd. Some banks charge 0.5 to 1% for a product that costs 0.1% in its direct version. Here is the maths. On a 10 lakh rupee investment, an expense ratio of 1% costs you 10,000 rupees per year. Every year, even in loss years. Over 20 years, that is 2 lakh rupees in fees before accounting for the lost compounding on that money. Always check the expense ratio before investing. SEBI has capped it as 2.25% for equity funds. Any fund charging more than 1% in direct plans is expensive. Exit load, the redemption penalty. Exit load is charged when you redeem your mutual fund units before a specified holding period. It is the fund's way of discouraging short-term trading. For most equity funds, if you redeem within 1 year, you pay 1% exit load on the NAV at the time of redemption. After 1 year, zero exit load. So equity funds for at least a year. ELSS funds have zero exit load, but they have a mandatory 3 years lock-in. You cannot redeem them even if you want to. Liquid funds have a graded exit load in the first 6 days. Extremely small, but it exists. After 7 days, zero exit load. Always check the exit load schedule before investing. This information is in every fund scheme, which is Key Information Memorandum, available on the AMC website. Total cost of investing. Let me give you the complete picture of all four charges in mutual fund investing. First is expense ratio, which is deducted daily from NAV, permanent 0.1 to 2%. Second is exit load, charged on redemption before the lock-in period, avoidable if you hold long enough. 3 is STT or Securities Transaction Tax, which is 0.001% on equity redemptions. Government tax, unavoidable but negligible. STCG at 20% for equity held less than 1 year. LTCG at 12.5% on gains above 1.25 lakh for equity held more than 1 year. Debt funds taxed at your income tax slab rate. The key takeaway: minimize expense ratio by going direct, avoid exit load by holding long enough, and plan your redemptions to minimize tax. These three actions alone can add lakhs to your final corpus. Now that we understand charges, let us understand risk, which is module number 7, risks and return ratings. How do you measure risk? How do you know if a fund's returns are genuinely good or just market-driven luck? Let me give you the tools. Think of this as slightly better than a savings account. Low to moderate. Ultra short and short duration debt funds for 1 to 2 year goals. Moderate. Hybrid and balanced advantage funds for 3 to 5 year goals. Moderately high. Large cap and flexi cap equity funds for 5 to 7 year goals. High. Mid cap and small cap funds for 7 to 10 year goals. Expect 30 to 40% temporary falls. Very high. Sectoral and thematic funds only for experienced investors with specific sector conviction and a 5+ year horizon. The rule is simple. Always match the fund's risks level to your investment horizon and your ability to tolerate temporary losses without panicking. Sharpe ratio, alpha and beta. 3 numbers separate genuine fund manager skills from plain market luck. Let me explain each one simply. Sharpe ratio. Three numbers separate genuine fund manager skills from plain market luck. Let me explain each one simply. Sharpe ratio. Return earned per unit of risk taken. Formula is return minus risk-free rate divided by standard deviation. A Sharpe ratio above 1 is good. Above 2 is excellent. Higher Sharpe means the fund gave you more return for every unit of risk you took. Always compare Sharpe within the same category. Alpha. How much extra return the fund generated beyond what the market index gave. A positive alpha of 3% means the fund manager added 3% more than the index after adjusting for risk. Negative alpha means the manager underperformed. If your active fund is negative alpha consistently, switch to an index fund. Beta. How volatile the fund is compared to the market. Beta of 1 means fund moves exactly with the market. Beta above 1 means more volatile. Large swings in both directions. Beta below 1 means less volatile, more defensive. You can find all three ratios on valueresearchonline.com under any fund's risk tab. Ideal fund, Sharpe about 1, positive alpha, beta around 0.85 to 0.95. This means good returns with slightly less volatility than the market. Standard deviation and measuring volatility. Standard deviation tells you how much the fund's monthly returns vary. A low SD means smooth, consistent returns. A high SD means wild swings, big gains, and big losses. A large cap fund with SD of 12% and a small cap fund with SD of 12% are completely different risk profiles. Because 12% is expected from small cap but high for large cap. Always compare SD within the same category, never across categories. Practically, if you check two similar funds and one has consistently lower SD with similar returns, choose the lower SD fund. Less volatility for the same return is always better. Risk stored. Now let us talk about tax. Module number 8. This module could save you significant money this financial year. Module number 8 is tax on mutual funds. This module is extremely practical. The decisions you make here, growth versus IDCW, when to redeem, how to harvest gains, can have a direct impact on thousands to lakhs of rupees on your post-tax wealth. Capital gains tax. Tax on mutual fund gains, called capital gains tax, depends on two things: the type of fund and how long you held it. For equity funds, if you hold for less than 1 year, gains are taxed at 20%. This is short term. Capital gains tax. If you hold for more than 1 year, gains above 1.25 lakh rupees per year are taxed at 12.5%. This is long-term capital gains tax. Gains up to 1.25 lakh per year are completely tax-free. For debt funds, regardless of how long you hold, gains are added to your income and taxed at your applicable income tax slab rate. This changed after Budget 2023. Debt funds no longer get indexation benefit. ELSS funds. Gains are taxed at LTCG at 12.5% above 1.25 lakh after the mandatory 3-year lock-in. You cannot exit before 3 years anyway. The most important rule: always hold equity mutual fund units for at least 1 year to qualify for LTCG treatment. Redeeming before 1 year triggers 20% STCG, a significant and avoidable cost. Tax harvesting, the legal wealth booster. Tax harvesting is one of the most powerful and most underused strategies in Indian mutual funds investing. It is completely legal, SEBI approved, and can save you thousands to lakhs in taxes every single year. Here is how gain harvesting works. Every March before the financial year ends, redeem equity mutual fund units with unrealized gains up to 1.25 lakh rupees. Immediately reinvest the same amount in the same fund. The result: your gain of 1.25 lakh rupees is realized. The result: your gain of 1.25 lakh rupees is realized. The result: your gain of 1.25 lakh rupees is realized and taxed at zero because it is within the tax-free LTCG limit, and your new cost basis is now 1.25 lakh rupees high. Future gains will be smaller on paper. You have legally deferred or eliminated tax. Do this every February or March. In 20 years of investing with consistent gain harvesting, you can save lakhs of rupees in tax that would otherwise have been paid. Loss harvesting works the opposite way. If you have a position sitting at a loss, you can book that loss and offset it against gains in another fund. Net result: your taxable gain is reduced. 2 hours of attention every February or March can save you 10,000 to 50,000 rupees in tax. I do this for all my clients at Fintamin. It is one of the highest return activities in all the personal finance. ELSS and Section 80C. Let me compare ELSS to the other popular 80C instruments to show you why it is the best option for most working professionals. PPF, Public Provident Fund, gives 7.1% interest, tax-free maturity, but 15 years lock-in. Good for ultra-conservative investors. Tax-saving FD, 6.5 to 7% return, but 5 years lock-in and returns are fully taxable at your slab rate. In the 30% bracket, net return after tax is barely 4.5%. ELSS, 12 to 15% historical CAGR, 3 years lock-in only, LTCG at 12.5% above 1.25 lakh. The best combination of return potential and lock-in period among all 80C options. My recommendation: max out your 80C limit with ELSS first. Use PPF only if you want a truly risk-free government-backed component. Avoid tax-saving FD unless you are in the 0% tax bracket. Dividend and growth option. Before 2020, mutual fund dividends were tax-free in the hands of investors. Many people chose dividend option for this reason. That changed with the 2020 Union Budget. Today, what was called the dividend option is now called IDCW, Income Distribution cum Capital Withdrawal. Any payout from this option is added to your income and taxed at your slab rate. In the 30% bracket, you pay 30% tax on every distribution. For 95% of investors, The growth option is the right choice. Your returns compound without tax drag. You control when to release gains. You pay tax only when you redeem at LTCD rates of 12.5%, which is much lower than slab rates. The only scenario where IDCW makes sense is if you genuinely need regular monthly cash flow from your corpus, like in retirement, and even then, a SWP from Growth Option Fund is more tax efficient. Now that you understand everything about mutual funds, let us put it together. How do you actually choose the right fund? Let us move forward to Module 9, which is choosing the right fund. I am going to give you a 5-step framework that you can use for any fund, any category, anytime. Follow these steps and you will never make a bad fund selection again. Step 1 and 2 are goal and category. The most common mistake investors make. They pick a fund first and then try to fit a goal to it. Do it the other way round. Step 1. Define your goal and time horizon. Emergency fund, liquid fund, etc. 1 to 3 years goal. Short duration debt. 3 to 5 year goal, hybrid fund. Tax saving ELSS. 7 to 10 years wealth building, large cap or flexi cap. Aggressive long term growth, mid cap or small cap. Step number 2. Choose the category that matches your goal. Then and only then look for the best fund within that category. Goal first, category second, and fund third. Step 3 and 4 are screening and deep dive. Step 3 is the initial screening. Use valueresearchonline.com or CRISIL to shortlist funds with 4 to 5 stars. Filter for minimum 3 years track record. AUM above 500 crore for stability. Fund manager tenure above 3 years and direct plan expense ratio below 1%. This shortlist should give you 3 to 5 funds in any category. Now step 4, the deep dive. For each shortlisted fund, download the fact sheet. Check, does the 5-year CAGR beat the benchmark? Is the Sharpe ratio above 1? Are the top 10 holding reasonable? Has the expense ratio been stable or increasing? Is the fund manager the same who produced the track record? After this process, you should be able to identify 1 or 2 clear winners in each category. This is your fund selection. Step number 5 and common mistakes. Step number 5. Decide and start. Open your account on Grow, Zerodha Coin or Quera. Select the direct plan. Start a SIP on the 5th or 10th of the month. Early in the month is better. Set an auto invest reminder. Now let me warn you about the 5 most common fund selection mistakes. First, chasing last year's top performer. Funds that top the charts 1 year frequently underperformed the next. Look at 5 years consistency, not 1 year fireworks. 2. Holding too many funds. If you have more than 5 funds, the additional diversification is 0. They all own the same stocks. And your tracking gets complicated. Third, stopping SIP during a market crash. This is the worst time to stop. When markets fall, your SIP buys more units at cheaper price. Crashes are gifts to SIP investors. 4. Unknowingly choosing regular plans. Always verify the word direct appears in the fund name before confirming the investment. 5. Never reviewing. Review your portfolio once a year. Remove ones that consistently underperform their benchmark for 3 or more years. Everything else, leave it alone. Annual fund review. Review your mutual fund portfolio once a year, not more. Over reviewing leads to over trading, which destroys return. 5 questions to ask at your annual review. Has the fund underperformed its benchmark by 2% or more for 3 consecutive years? If yes, then switch to an index fund. Has the fund manager changed? If yes, monitor for 6 months before deciding. Has the AUM grown very large, especially in a mid or small cap fund? Large AUM hurts performance in smaller stocks. Is your goal now only 2 years away? If yes, start shifting from equity to debt. Has your allocation drifted significantly from your target? If yes, rebalance. That is it. Annual review. 5 questions, 30 minutes, and then leave it alone for another year. Let us now put everything together. Module 10, Building your mutual fund portfolio. Building your complete mutual fund portfolio. This is where everything comes together. By the end of this module, you will have a clear, actionable portfolio structure customized to your risk profile. Asset allocation, the foundation. Before choosing funds, you must decide on asset allocation. How much of your portfolio goes into equity versus debt versus gold? This single decision determines 90% of your portfolio's risk. The rule of 100 is the simplest starting point. Equity percentage equals 100 minus your age. If you are 30 years old, 70% equity and 30% debt. If you are 45, 55% equity and 45% debt. If you are 60, 40% equity and 60% debt. This is a guideline, not a rule. If you have a high risk tolerance, add 10% more equity. If you are conservative, subtract 10%. The most important thing is to have a defined allocation and to stick to it. Conservative portfolio. For conservative investors, typically aged 50 and above, or anyone with low risk tolerance, here is a model portfolio. 30% in liquid or ultra short debt. This is your stability anchor. 25% in short duration debt for slightly better returns with minimal risk. 25% in large cap index fund because even at 65, you need equity to beat inflation. 10% in a conservative hybrid fund, 10% in gold ETF or gold fund as a hedge against uncertainty. Expected return 8 to 10% CAGR, maximum drawdown in a bad year 10 to 15%. This portfolio lets you sleep well at night. One important reminder, even in retirement, you need some equity. Inflation at 6% will halve the purchasing power of your corpus in 12 years without equity growth. Never go 100% into debt. Moderate portfolio. For moderate investors, typically aged 35 to 50 with balanced risk tolerance, here is a model portfolio. 35% in Nifty 50 index fund, your core low cost stable anchor. 15% in ELSS tax saver. benefit plus equity growth, 15% in a flexi cap or quality fund, active 25% in short duration debt, stability and rebalancing source, 10% in gold ETF, crisis hedge. Here, this is a 65 to 35 equity to debt split. Expected return 10 to 12% CAGR. Maximum drawdown in a severe correction 20 to 30%. But recoveries are faster with the debt cushion providing ammunition to rebalance. This is a 65 to 35 equity to debt split. Expected return 10 to 12% CAGR. Maximum drawdown in a severe correction 20 to 30%. But recoveries are faster with the debt cushion providing ammunition to rebalance during crashes. This 5-fund portfolio is what I recommend for the majority of my Fintamin clients aged 35 to 50. For aggressive users, typically aged 25 to 35 with high risk tolerance and a 10 plus year horizon, here is a model portfolio. 25% in Nifty 50 index fund, your anchor 25% in mid-cap fund, growth tax benefit, 15% in small-cap fund, high-octane growth, 10% in international gold ETF, crisis hedge. Expected return 13 to 18% CAGR over a 10 years horizon. Maximum drawdown in a severe crash 40 to 15%. This portfolio will fall 40% in a bad year like 2008. The key is not to panic and not to stop the SIP. Are the ones who kept their SIPs running through every crash. 2008, 2011, 2013, 2016 and 2020. Every crash looked like the end of the world. Every time the market recovered and went to new heights. Stay invested, stay systematic, and trust the compounding process. You have completed Mutual Funds Masterclass, course number 2 of Fintamin Financial Education series. Let me give you your action checklist. 1. If you are currently in regular plans, switch to direct on mfcentral.com this week. 2. Start an ELSS SIP of 12,500 rupees per month if you are not already saving tax through ATC. 3. Build your portfolio based on your risk profile, conservative, moderate, or aggressive. 4th, use only growth option, never IDCW. 5. Review once a year, not more. 6. Do gain harvesting every February or March. These 6 actions implemented consistently will compound into extraordinary wealth over 10 to 20 years. I have seen it happen for clients. I want it to happen for you. If you have questions, reach us at fintamincare@gmail.com or WhatsApp us on 9860148848. Fintamin's mission is to democratize financial planning for every working professional in India, starting with you. Course 3 is Technical Analysis, the complete charting course. Course 4 is Futures and Options Foundation, and Course 6 is the Institutional Trading Framework. Each one builds on the last. Thank you for your time and your trust. See you soon in the next course.